And away we go. Last chapter, chapter 23, it's mostly talking. There's a few examples in there. What I've given you is an example document, and it's got some questions on it that we'll go through. And then you have a PowerPoint package, which you can take some notes on. Most of this, like I said, is talking and not calculations. And then you have, of course, the practice questions. And if you look at the practice questions behind that, what I've done is kind of just pulled things from the chapter. I cleaned them up a little bit. I didn't change too much. And this is just going to be for your reference. You know, you're doing something, you wanted to look at them. I'm not going to cover all of the notes and the financial statements and what you're supposed to do or everything in this chapter because there's, you know, it touches on 30 things individually. I'd rather focus on the more challenging things and some of the things that are a little more common. But notes are important. You can see what's required for the disclosure in that. So if for now, you guys would do the practice questions 1 through 5 in about 2 or 3 minutes, I'll go over them. And all this, by the way, is out on the website if you want to work on and use electronic forms, it's all available. All you do is go into our course, go into modules, and you have the 3 sheets at the bottom of the first level, 17A, B, and C. Okay, so let's walk through these practice questions. Which of the following best describes the full disclosure principle adopted by the accounting profession? And that one would be D. Disclosure of any financial facts significant enough to influence the judgment of an informed reader. I don't know why they've gone to significant versus material. Just something I have to kind of do a little bit of reading on. But you know, here significant implies, I think, a statistical kind of significance versus materiality, which they kind of had numbers for. So here we know that it's got to be fairly big, right, to be disclosed on the financial statements. And they want you to try to disclose all of those things. According to GAAP, the disclosure of accounting policies adopted by a reporting entity is important to financial statement readers in determining depreciation methods, amortization policy, handling of marketing costs, and inventory valuation method. 3, which of the following post-balance sheet events would require adjustment of the accounts before issuance of the financial statements? So this post-balance sheet is that time period that they're referring to is after the financial statement period has closed. So let's say you're closed on December 31st, but before you release the audited financial statements to the public, so like February 2nd or something like that. So if something happens in that time, and it's material, then you have to disclose it, or in some cases like this one, would require an adjustment of the accounts, would be, this one would be a loss on a lawsuit, the outcome of which was deemed uncertain at year end. Because essentially what they're saying is, if you're going to adjust the financial statements, it had to be occurring prior to the end of the financial statement date. If this occurred after, like the lawsuit and everything, after the financial statement date, and you had a judgment, something real quick, obviously wouldn't happen, but you would disclose that. Revenue of a segment includes sales to unaffiliated customers and inter-segment sales. Now, I got this one wrong when I was doing it because I thought they eliminated inter-segment sales. Because when you have inter-segment sales, you have to eliminate it from your consolidated financial statements. And so this one's a little wonky, but they made note in the chapter that you don't necessarily have to follow GAAP for your reporting of your segments, but you do have to follow GAAP for your financial statements. So you have some leeway in reporting revenue for the subsidiaries. If the financial statement's examined by an auditor, the auditor issue an opinion that contains an exception that is not of sufficient magnitude to validate the statements as a whole, the opinion is said to be, and this is qualified. Yeah, not in accounting. So D, B, E, B, and B. Okay, so for the most part, the rest of this is just something useful to you have on your exam. Just talks about the full disclosure principle, notes to the financial statements, special transactions, related party transactions, post-balance sheet events, reporting for diversified companies. You'll learn about consolidations in advanced interim reports. We'll talk about the auditor's reports. But this is kind of a good thing to have with you when you're taking the test. And so that will be available to you. What I want to go to next is the PowerPoint. So it says Handout 17C. You guys should have two a page. Once we're there, everybody there? Sweet. All right. So intermediate accounting, full disclosure principle. So we just talked about that. If it's going to let me edit it. And this is calls for financial reporting of any financial facts significant enough to influence the judgment of an informed reader. Informed means business qualified kind of thing. Like you've gone to a business school, you've got a college degree, you're working as an investment person, those types of things. They don't expect somebody from the public to just be able to pick up the financial statements and read through them. It's necessary that you develop the expertise and become informed. So we talk a little bit about the types of financial statement or financial information. And so you look at the first four financial statements, notes to the financial statements, supplementary information, and other means of financial reporting. So you can see that when you look at this, the areas directly affected by existing FASB rules are these first three. But the SEC has some requirements for other companies that they have to, do a sustainability report or letters to stockholders, that type of stuff that doesn't go through the GAAP process. Now, the SEC requires management's discussion and analysis in the financial statements, but as auditors, you do not audit them. And there are non-GAAP numbers in there. When I was an auditor, so this was 20 years ago now, we used to just check it to make sure that all of that information that was included in there, if it was included in the financial statements, was accurate. And so that was all our requirement, was to do whether or not it fell under GAAP or GAS. But here you have these three FASB reporting rules, not under the FASB, and then outside, news articles, economic statistics, those types of things. And those are decision relevant information. And businesses exist over here and disclose things, especially news articles and news releases. You're familiar with some of the reasons for disclosure requirements. And here they're talking about how complex the business environment has become. Now, we covered some of these things in this class, like pensions, right? Leasing. You covered revenue recognition in an earlier intermediate. And then, of course, we covered deferred taxes. So you're going through and seeing how challenging these aspects can be to report. And so as much disclosure as reasonably possible will help reduce or help your investors understand the complexities of the business. Necessity for timely information. So this, they're kind of talking about the quarterly reports. Businesses used to kind of do one of two things. They'd say, here, we're on our way to our goal. I'm just going to divide it up and roughly be quarterly. Or they could look and say, this is what our expectation is for the year based on how much we've covered. This is where we're at. And so you'll see it when we talk about the interim financial reports, and there's I think it's direct and indirect, but we'll talk about it a little bit. Okay. Accounting as a control and monitoring device, obviously, right? This is for financial markets. It's very important that they're reliable, and it's also that investors have some confidence in them. Now, the government has recently sought public disclosure, such as management compensation, off-balance sheet financing arrangements, related party transactions. So they're going to auditors and accountants and asking where this information is. So these are some of the reasons out there for disclosure requirements. And it's kind of away from the financial statements. Now, the second part of your chapter, Learning Objective, talks about all of the things that you should include in the notes to the financial statements. And I just wanted to start with this one because all of them have a paragraph, and I don't want to read through all of them for you. We've kind of talked about the disclosure in each of the chapters. But this is important. So the company should have all of its important accounting policies, and we talked about them included in one accounting policy footnote. And it either should be the first note or a separate summary that precedes the notes. Okay? So the first thing you look at when you go to the notes should be your accounting policies. And we talked about those questions on the front. What are we trying to figure out? We need to know our depreciation method. We need to know our amortization policy, the handling of marketing costs, inventory valuation, those types of things are disclosed here. And it also references the notes in detail. So it'll give you a short thing saying we use LIFO, see our notes to our financial statement in this accounting section. So it's super important. I did this earlier today. Let's see if it will go as smooth. And one of the things that they talk about, and my dissertation was on, is this thing is like 121 pages long. And we're just looking at what was filed with the SEC. If you look at the annual report, it's all glossy and pretty. And by the time you get to page, whatever it is, the financial statements are on 28, you've already gone through all the positive things that management wants to show you. So unless you're ignoring that stuff and just going right to the financial statements, you can be kind of misled from the first part of the financial statements. I want to show. For the accounting policies. So first note, summary of significant accounting policies. And so it gives you all these little breakouts, but it's going to have a note on property, plant and equipment, derivatives, income taxes, and leases. So you can see this just kind of highlights some of the important stuff. It gives you sort of a Cliff Notes version of how they account for these various areas. Related party transactions. So disclose the following with related party transactions. The first one is the nature of the relationship. Description of the transactions. Each period the financial statements are presented. Dollar amounts of transactions for each of the periods for which income statements are presented, and amounts due to or from to related parties. I need the last part. It's redundant. So you'll find this out when you go into advanced accounting when we do business combinations. In related party transactions, you have to eliminate them. But in your financial statements, you want to make sure that you disclose the transactions and what happens between them. Why would we want to back out transactions between related parties? It's because we're assuming those transactions aren't at arm's length because you work with them, you have influence over them. So you may have influence in what the prices would be, what the rates would set, and maybe what's best for the company, but not actual revenue production from your shareholders. Post balance sheet events, subsequent events. So if something happens during the year, but you don't find out about it until after the balance sheet date, you are required to go back and restate the financial statements. If you find out about something important that happened after the balance sheet date, but before the financial statements are out, let's say your biggest customer goes bankrupt and you have millions of dollars that they owe you. And now all of a sudden that becomes uncertain. You would have to disclose that. And it would have to go in the financial statements. Events that provide additional evidence about conditions that existed, and this is important, at the balance sheet date, including the estimates inherent in the process of preparing financial statements, These events require adjustments to the financial statements. So this is another thing where auditors can really dig down into an area and look at it, right? So let's say accounts receivable. If most of your accounts receivable is due within 30 days, if when you close the balance sheet date, what should you see in that next month? You should see them getting the payments, right? And so as an auditor, I can go back into their system, look at the payments that they match it to a corresponding bank statement and see that those payments have occurred. So when a company says, you know, there's some uncertainty, we may have something, you know, we have to buy commodities in the future, something like that. When it occurs in that period after the balance sheet, you can still include it in that information that you're providing in the financial statements. All right, some examples. Settlements of litigation. And this would be if took place before balance sheet date. Warranty obligations. If occurred before the balance sheet date. So this would mean that products related were sold prior to the balance sheet. You guys are probably young / old enough to remember Firestone had a big issue with its SUV tires. It started out on Ford trucks, but it ended up expanding. So if you get an example, the government hit you in January with a recall, that would be something like this. All of a sudden it's under a warranty obligation. And some other things are a tax dispute related to taxes payable. And so again, it had to occur from a prior year, but happened before your financial statements were released. Doesn't work when you're not doing this show, but one of the examples, a loss on accounts receivable results from a customer's bankruptcy subsequent to the balance sheet date, but before the financial statements are issued. How should this event be accounted for, if at all? So I would think, okay, it's subsequent to the balance sheet date, but what they say is that you should adjust the financial statements before the issuance to reflect the loss, because the bankruptcy stems from the customer's poor financial health existing at the balance sheet date. And so basically what they're saying is you should be responsible to know what happens through that year, even if that information comes later. All right. And so you would adjust those financial statements. You would take it out of accounts receivable and into allowance for doubtful accounts, assuming you had enough. The second category would be non-recognized subsequent events. And these are conditions that did not exist at the balance sheet date, but arise subsequent to that date. They do not require adjustments of the financial statements. But again, it's a good idea to disclose these in the notes or somewhere else if one of these things occurs and it's material and it could affect your business. So for example, Boeing, let's say they closed their year and then all of a sudden their employees went on strike. We know they're on strike, or they were on strike. So if that happens, then Boeing would say, hey, our employees are on strike. It happened after the balance sheet date, but if it if something doesn't change quickly, we could incur additional losses. Okay, significant commitments or contingent liabilities. We've probably all heard the stories of Walmart sort of bankrupting customers or suppliers, by getting into significant relationships with them and then getting out, or making them move somewhere where they are and they just struggle to produce. But Rubbermaid was one of them, and I think they were Newell Rubbermaid at the time, and they did a whole bunch of business with Walmart, and then Walmart said, we're going to go to a cheaper source, and so all of a sudden that company was screwed, because it lost a lot of its ability to generate future sales when a big customer like Walmart leaves, and a bankrupt in the company. All right. Like I said, this kind of jumps around, so I'm hitting each of these topics relatively quickly. I apologize, my transition is not great. Objective of reporting segmented information. So now we're moving from subsequent events to reporting segmented information. Now, again, this is something that has quite a bit of a gray area to it, but the nice thing is that they provide us with some tests to tell us whether or not you should report the segment information. Now, if you've had managerial accounting, you know that it's likely all of the managers and the important executives are looking at this information. So they should have it available to disclose by segment. And so how does this help users? And the first one would be better understand the enterprise's performance. Better assess its prospects for future cash flows. Sorry, future net cash flows. We know those outflows go easy, right? And you make more informed judgments about the enterprise as a whole. I found it interesting in the chapter, it talks about how Amazon, nobody knows how much of their revenue is generated from Prime customers. But it would seem if you were an investor, you'd want to know that, because if we think about all the other subscription services, they get reported almost on a quarterly basis, sometimes on a monthly basis, right? We know exactly what happened to Netflix subscribers. Now, Amazon is different in that not only does it have that subscription, but it also it sells its own inventory, it sells other services, it sells others' inventory. So it's different than that company. But the fact that such a big part of it is not being disclosed is really interesting, because in general, our rules say something like that should be disclosed, and the SEC has been battling with Amazon for some time about that. Basic principles. GAAP requires that general purpose financial statements include a segment on a single basis of segmentation. Company can meet the segment or recording objective by providing financial statements segmented based on the company's operations are managed, so the management approach. There's a couple different ways you can disclose segments. One would be like geographic. The other way that this is the better way is to say, these are the types of businesses that are similar, so we're going to group them together. Segmented information reported. And if we go look, let's see if Apple's got anything for segmented information. There you go. Okay, so this is an example of it being disclosed. So they have it by location, Americas, Europe, China, Japan, but they also list it down here below by years. And then US, China, other companies, more details, long-lived assets and where they're located. And so they choose to do theirs geographically. Could they do it by like computers, phones, service, and other? Yeah, they could do it that way as well. Okay, so there's a lot of flexibility in this, and it kind of makes it a pain to learn. And I'll admit, I'm not going to be throwing zingers at you on the test. Try to be straightforward with it. Try to make sure that I'm not just working to try to confuse you. Identifying operating segments. This is nice because they give us kind of a formula for identifying these segments. And so it engages in business activities from which it earns revenues and incurs expenses. Whose operating results are regularly reviewed by the company's chief operating decision maker. And this is important. So one of the first things that you're doing when you establish an audit is a partner wants to first assess what are the risks for the company. And it also wants to know what managers, what CFOs, what CEOs look at on a day-to-day basis. Most CFOs and CEOs don't look down to see whether or not Tom Jones was working on a Tuesday. They look at full segments and full segmented information. So if you are using this as a manager, then chances are, if it meets these tests, you want to make sure that you're disclosing it. And then the last one would be for which discrete financial information is available. Yep. Yeah, it used to be a lot more important because it used to determine whether or not you paid taxes on it. Now, with the internet sales, you didn't pay taxes on things that you did not have nexus in those states. So states were losing a lot of internet revenue. And so now, of course, internet revenue, they're allowed to charge taxes for the specific states, even if. Right. Yeah. Yeah, where is it being shipped to? Okay, so these are nice because these are tests to report to determine the reportable segments. So if you break out your segments and you decide that the sales to both external and inter-segment sales is 10% more of the combined revenue of all operating segments. So is it 10% of our total revenues or sales? This one I still can't understand. The absolute amount of profit or loss is 10% more of the greater in absolute amount of the combined profit of all operating segments that did not incur a loss. So basically you're taking all of the ones that got positive profit, and does it meet the 10% mark for there? or B, the combined loss of all operating segments that did report a loss. So if it's a loss, if you have multiple segments, was it 10% of that loss? And last, the assets related to the segment are 10% or more of the combined assets of all operating segments. Now you have two more steps that you also have to check. Once you've done these segments, you have to make sure that you account for 75% of combined sales to unaffiliated customers. Now it's a little weird to me because you're kind of doing inter-segment sales with that, so it's pumping up your number, but they don't ask you to make an adjustment on it. And then are too many segments being reported? 10 is the upper limit that the FASB has said you should disclose, but not more than 10. Okay, so let's take a look and then we'll put this example to work. Okay, so this is where I'm getting the data, and then I'm going to go ahead and make the calculations here. So Watson would apply these steps as follows. Which segments meet at least one of the 10% tests? So we're going to go back here and we're going to say, okay, what's 10% of total revenue? So 2150, we got 0.1 times 2 million, or 2150, and that equals 215. So we go back and we look and we say, okay, what's bigger than 215? We have C, D, and E. So C, D, and E meet those requirements. Operating profit or loss. So here, 0.1 times, and we have our operating profit or loss here of 85,000, or 85 in millions, sorry. Oh no, mountains and thousands, okay.
When you do 85 minus 85, it says that did not consider a loss.
Right, yes, you're correct. So it's minus 85 minus a negative 5. So we get 1 times 90, or 0.1 times 90, sorry. And so that equals operating profit of 9. And so we'd go back and say, does any segment have this test or meet that test? And so we have A, C, D, and E. And then the identifiable assets test, so 0.1 times our total assets, which are 970. I could only remember that one. But our total identifiable assets are 970. So this one would be 97. And so which ones meet 97 in terms of identifiable assets? And we have C, D, and E. So we have A, and C, D, and E. And so we want to look up the 75% of combined sales. So our sales total is 2150 that we said, so 0.75 times 2150. And that equals 1613 rounded. And so A, its sales were 100. Plus C, 700 plus D, 300 plus E, 900. And that equals 2,000. And so yes, met 75% test. And are there too many segments being reported? No, less than 10. Leave that up there. Any questions? All right. So now we're jumping to interim reports. The SEC requires public companies to file quarterly reports. Companies are trying to get them not to. Investors are trying to get them to put more stuff into it. It is an expense. And so there are lighter loads on this. So they should use the same inventory methods for interim reports. However, there are some exceptions. They're listed in the book. Companies often charge to the interim period as incurred costs and expenses other than product costs, referred to as period costs. And so when you have the discrete approach, so when you're doing interim reports, we can think about something like warranties, right? So if we sell inventory during the year, if we're a normal company, we probably have a big end of year, right? So that probably means you're going to have more warranty expense early in the next part of the year. And if you're doing quarterly financial statements, that may throw things off. So you have the option on some things to take the full number and just divide it up into quarters and then true it up in the annual report, or to report quarterly based on what happened in those quarters. So you have two choices as management, and the integral approach allocates required costs based on the activity during period sales or expenses. And when you think about it, it's kind of like activity-based costing versus just your regular costing, right? If you were costing and you had manufacturer's costs, right? You have direct material, direct labor, and manufacturing overhead. And that manufacturing overhead is usually allocated based on one rate for like a whole plant. But with activity-based costing, they said, listen, it doesn't cost the same, and let's say you're doing vehicles, to paint a car as it does to add oil to the car, right? So if you have two different sections of the factory, we can now allocate those overhead to those specific sections. And so that's what activity-based costing does. This approach is more reflective of what happened during the quarter and what's expected to be allocated to them based on their sales versus what actually happened. And so it kind of reduces the seasonality of statements. In the book, they talked about, oh goodness, I'm going to forget who it was, but basically it had sales in the summer and then nothing else going on. So there is a helpful thing. If you watch the first video in the course resources, this one, accounting analysis and principles light board video. If you're struggling at all to understand interim reporting, it's helpful. Okay. Okay. Regarding disclosure, the company should report the following interim data at a minimum. So sales or gross revenue. Some companies don't do an income statement or a balance sheet. It's not required quarterly. Basic and diluted EPS. Seasonal revenue or expenses. Significant changes in estimates. Disposal of a subsidiary or related business. I'm running out of room here. Contingent liabilities. Unusual or infrequent. These are usually acts of nature that don't occur often. Right? We live in Tornado Alley. If our business gets wrecked by a tornado, that's not unusual or infrequent, right? That happens. So that's not the same thing. But if you're in an area where tornadoes never happen and you get one every 40 years, like in Massachusetts, and it destroys your business, that would be an unusual or infrequent activity.
Year ago, 2 years ago, we got that snow, pops over flat top building.
Yep. Yeah, you guys had a huge amount of snow here, right? It was like you guys were locked up for like a week.
So I just moved here, my senior year. I was like I knew we moved up like further north. We're still in Texas.
Great. Oh, I'd be shocked if I saw that much snow. Yeah, exactly. All right, so there's a couple more change changes in accounting principle. And then the last one would be significant changes in financial position. Okay, so now we're moving on to not necessarily what is required of us, but what happens with an auditor. And so I want to put something before this here. Auditors follow reporting standards. And it used to just be kind of, we listed gas here and moved on, but they have some things that they want you to know. One, that they have to report whether financial statements are in accordance with GAAP. So that is a requirement. Number two, report circumstances in which the company has departed from GAAP, current versus prior year. That you regard disclosures as adequate in the financial statements. And then the last one is either express an opinion or no opinion and state why. So that's what their reports are required to have. Now, a specific unqualified opinion is pretty straightforward. That the financial statements are presented fairly in accordance with GAAP. So there's no exceptions there. Right. Well, keep in mind, when you do this, you kind of state your procedures, like what you did in order to do this. And it's important to note that these aren't your financial statements, and you're only expressing an opinion on it based on the work that you did, not necessarily guaranteeing or anything of that sort. All right. Now, the next type of auditor's report would include an explanatory paragraph. And you add a paragraph when the company is a going concern. Means that it's going to go out of business within 1 year. Number two would be lack of consistency in accounting standards, principles. So from year to year, they didn't make the proper adjustments. And so one year is hard to compare to the other. And then if they want to emphasize a matter, which I don't have a good example for you. But maybe a big lawsuit or some government regulation would be something that falls in that category. These are not all the cases. These are just the big ones. And the explanatory paragraph usually goes with an unqualified opinion. It's just something that you want to bring additional information to. The auditor's report for qualified opinion contains an exception to the standard opinion. Unusual circumstances may include scope limitation. The auditor was unable to perform the audit for whatever reason. Statements do not present fairly according to GAAP because lack of conformity with GAAP or inadequate disclosure. So a qualified opinion, again, is they've got this problem, but we still think the rest of their financial statements are okay and that they're presented fairly. Number 22, adverse opinion. Required when exceptions to fair preservation are so material that an independent auditor judgment are not in accordance with GAAP. Man, they use a lot of words. Couple things of note. Adverse opinions are rare. The auditors and clients out or an auditor will drop the client. And then the last part is the SEC does not permit a company listed on an exchange to sell shares, right? To have an adverse opinion. And when the auditor drops the client, that's when they disclaim usually, which we'll talk about next. Okay. Disclaimer of opinion. When the auditor has gathered so little information on the financial statements that no opinion can be expressed. And where it says so little, it also can be important information. Like if somebody says they have $1 billion in a bank in India, if you can't confirm that, that would be, it's not so little information, it's just that you can't confirm it and it's so big that you would have to disclaim it. Okay. Couple more. Management's discussion and analysis. So this is not audited or reviewed in the sense that auditors are performing specific procedures on it. Management is required to highlight favorable or unfavorable trends related to. One is liquidity. Capital resources. And results of operations. And significant events and uncertainties that affect these 3 factors. And so coming back here to Apple. Ooh. Okay, so we have management's discussion and analysis of financial condition and results of operations. So it starts on 21 and then goes to 27. And so they give you information about products and services, performance, fiscal period, macroeconomic conditions, kind of their segments, products and services. These are things that management wants to highlight for investors. Right? And again, a lot of these things are non-GAAP. And so we don't report on it. But we do make sure that if anything is reported from our financial statements, it is accurately reported. Management's responsibilities for financial statements. So prior to 2003, management could and would often go, I have no idea what the accountants were doing when they got themselves into some big fraud issues with their financial statements. And so the Sarbanes-Oxley Act requires the SEC to develop guidelines for all publicly traded companies to report on management's responsibility for an assessment of, and this has been mentioned before by Carter, internal control system. the CEO and the CFO certify the internal controls and the financial statements and face penalties, including prison time, if caught committing fraud. And then the last thing is, what is fraudulent or financial reporting? Intentional or reckless conduct, whether act or omission that results in materially misleading financial statements, which apparently can be done by one person in a huge company. Reporting for fraudulent, our opportunities for fraudulent reporting. So where do these things come from? How can we prevent them? And so we know internal controls is kind of one way to do it. What are some of the other ways that can happen? So weak or non-existent internal controls. The second one, absence of a board of directors or audit committee, which I don't think most of the public companies can have anymore. Unusual. Or complex transactions, right? That's especially occurred in finance and, you know, kind of caused some of the problems that we had in 2008. Counting estimates requiring significant, subjective judgment. And then the last one would be ineffective internal audit. Obviously, that's not everything, but that's some of the big ones. Management's tone at the top is also something that can affect those as well, right? And then it can also affect how the corporation is. And then the last piece we have is reporting on financial forecasts and projections. So typically this falls under kind of non-GAAP reporting, where you're projecting the financials, because we don't really have rules to project what's going to happen to our financial statements. But management sometimes does do analyses and they provide that information. The FASB and the SEC would like more of this information, but since it's non-GAAP, it is only what the companies decide to disclose on these. So financial forecasts and financial projections, a lot of the big companies do this anyways because they want to curry favor with investors, and investors tend to rely on the analysts. And so by providing this information, you help the analysts do their job. And so it kind of curries favor with them. Any questions on the material? All right, on Thursday, we'll go over some practice questions. I don't expect the class to last the full class, so, you know, plan to be out of here like 4:45 at the latest. Okay, see you on Thursday. Thank you. Just so many things on it.